The debt ceiling is a limit on the total amount of money that the U.S. can borrow to fund the government and pay its obligations. It was first established by Congress during World War I to give the Treasury Department more flexibility in borrowing money for the war effort. Since then, Congress has raised the debt ceiling 78 times, usually without much controversy. However, in recent years, the debt ceiling has become a source of political conflict and economic uncertainty. Some lawmakers have used the debt ceiling as a leverage to demand spending cuts or policy changes from the president. This has created a risk of defaulting on the U.S. debt, which could have catastrophic consequences for the economy and global markets. The U.S. debt is composed of two main parts, public debt and intragovernmental debt. Public debt is the money that the U.S. owes to outside investors, such as foreign governments, banks, corporations and individuals. Intragovernmental debt is the money that the U.S. owes to itself, such as Social Security trust funds, Medicare trust funds and federal employee retirement funds. The U.S. debt has grown significantly over the past 2 decades, due to several factors, such as wars, recessions, tax cuts, stimulus spending and the COVID-19 pandemic. As of May 2023, the U.S. debt stands at $31.4 trillion, which exceeds the current debt ceiling of $28.4 trillion. The Treasury Department has been using extraordinary measures to keep paying the government's bills since August 2021, when the last suspension of the debt ceiling expired. These measures include suspending investments in certain trust funds, redeeming existing investments in other trust funds and borrowing from other federal accounts. However, these measures are not enough to cover all of the government's expenses indefinitely. The Treasury Secretary Janet Yellen has warned that if Congress does not raise or suspend the debt ceiling by early June 2023, the U.S. will run out of cash and default on its obligations for the first time in history. A default would mean that the U.S. would not be able to pay its creditors, its employees, its beneficiaries or its contractors on time or in full. This would damage the U.S. creditworthiness, increase its borrowing costs, trigger legal challenges and lawsuits, and undermine its role as a global leader and reserve currency. A default would also have severe repercussions for the U.S. economy and global markets. It could cause interest rates to spike, stock prices to plummet, consumer confidence to collapse and job losses to mount. It could also spark a financial crisis that could spread to other countries and regions. Therefore, raising or suspending the debt ceiling is not a matter of choice but a matter of necessity. It does not authorize new spending but allows the government to pay for what it has already spent. It does not increase the debt but prevents it from becoming unmanageable. It does not benefit one party or another but protects the interests of all Americans and people around the world.